If you are contributing 1 penny more to your 401k or other employer-sponsored plan than your employer will match, stop right now. We'll explain why in today's video.
Now, Amber, we are saying that most people should be contributing at least the amount required to get the employer's match, whether it be your 401k, TSP, or 403b. So if you're not doing that, that should be your first goal, right? Get up to that amount that they will match. This video is talking to those people who are putting in more than that. Maybe their employer matches 5% and they're contributing 10%. We're going to give you 5 reasons why you should not do that.
That's right. So reason number 1 is in case of emergencies. Now, what does that mean? Because we know that things pop up for everyone, whether it be medical bills or home repairs or auto repairs, things pop up. So why is that a problem with an employer-sponsored plan?
Any employer-sponsored plan will have hoops to jump through, right? You have to go to HR. You have to determine, is this an in-service distribution or a loan? If it's a loan, it has to be paid back. If it's a distribution and you are under age 59 and a half, there will be a 10% penalty on top of the tax owed. So imagine, Amber, for a moment, say that we have a $5,000 medical bill that we need to cover and we don't have it in our budget to do that. So we go to our 401k plan, we withdraw $5,000, there is a $500 penalty for doing so.
Absolutely. Okay, so in case of emergencies, you need to have some savings outside of your company-sponsored plan.
Correct.
Okay, so what is the second reason that people need to be aware of?
Well, the second reason, Amber, is just simply better investment options. According to a recent article from Fox Business, the average employer plan has about 10 to 20 fund options. In fact, we do a lot of work for federal government employees, and they actually only have 5 options to choose from. That's it. 5 options is all they get. Outside of employer-sponsored plans, there are literally thousands or tens of thousands of different investment options to choose from. So you have a lot more variety for what you're looking for.
So reason number 3 is to give you a lot more control over your taxes. Now, how do we have control over our taxes? What does that mean?
Well, we get to choose a little bit, don't we?
A little bit.
So there are different tax rates depending on the type of income you have. Any money that comes from an employer-sponsored plan, if it's a traditional 401k or TSP, and it's tax-deferred money going in, that's all taxed at ordinary income tax rates when that comes out. So somewhere between 10 and 37%. That's pretty steep,
right,
on the federal level. Well, compare that to a Roth IRA. If you were to contribute just enough to get your employer's match into your 401k and then save more into a Roth IRA, for example, money coming out of there is tax-free. The growth grows and it's not taxable when it comes out. Or even if money were to go into a brokerage account, those are taxed at capital gains tax rates of 0, 15, or 20.
So it looks like the highest tax rates are found usually in the employer plan. Now tell us something that people might not understand. If you take money out of your Roth IRA before age 59 and a half, is there a penalty associated with that?
No, going back to what Amber said about emergencies, you can always take back your contributions to a Roth account. Only the growth or the earnings have to be there 5 years to be tax-free. But because the Roth money going in has already been taxed, you can take it back out in an emergency. So again, go back to our example. If we had saved money in a 401k plan and then saved an additional $5,000 into a Roth IRA, and now we have that $5,000 medical bill to cover, we can take money back out of the Roth IRA, no penalty.
Okay, so reason number 4 to save outside of your employer plan is to have the services of a professional advisor.
When you are investing in your employer's plan, it's up to you to pick which funds to allocate your money to, right? You've got to do your homework, you've got to do your research, you have to know your risk tolerance. If you have a Roth IRA or a brokerage account outside of your employer's plan and you're having the help of an advisor to manage those accounts, well, that advisor is probably going to give you advice not just on the investments, but also your insurance, your taxes, long-term care, estate planning. And they'll probably look at your employer plan and give you some direction on how you should invest your funds going into that.
Absolutely. So you want to have a professional advisor to give you some direction.
Now, the 5th reason, Amber, is it's better for your heirs. Now, we've done other videos that have talked about this, right? money left in a traditional 401k, TSP, 403b, 457, TSA, whatever you want to call it, employer plan, when it passes to your beneficiaries, they will inherit that at their individual income tax rate. They will also be subject to the 10-year distribution rule, which means if it's not a spouse, they will have to take all of the money out in 10 years or less in most cases. And then all that income will be on top of their other income. Now, we've talked about this as well. With Roth IRAs, they'll inherit that tax-free. They still have to take it out within 10 years, but there's no tax. And then one thing that people often forget, Amber, I'm going to ask you, we mentioned just a few seconds ago, but what is the lowest tax rate for capital gains in this country?
0.
0, right? That is the actual tax rate. Do you know that if you pass away owning an asset that is subject to capital gains, that capital gain tax is wiped out? The government calls it a step up in basis at death.
So lots of reasons why you should be contributing outside of your employer plan. You need to be contributing up to the employer match.
Correct.
But nothing more.
That's right.
So if you're looking for an advisor that can help you make these outside investments, click on the link below to apply to become one of our clients.
Remember, you can make the rest of your life the best of your life.
Plan now to retire happy.